The arrival of SQ329 from Amsterdam marked a milestone in Singapore's handling of the COVID-19 epidemic. For the first time since the island's borders were closed in March 2020, vaccinated travel lanes with 10 countries were open. More flights were scheduled to arrive in Singapore this week from Europe and North America. The border openings are part of Singapore's transition from pandemic to endemic.
The impact, if you want to put a number to it, it's probably around 37 plus billion in terms of the impact to GDP. So you can see the dramatic impact of the pandemic if we were to not reopen our borders.
The opening of the borders announced on October 9th had an immediate impact when markets opened.
Hospitality, of course, hotels, they were the epicenter. The next will be aviation. Even land transport will benefit. But in general, the whole economy will benefit. In 2019, we had tourism receipts was almost 28 billion, which is roughly 5 percentage points of Singapore economy. So we could get a 5 percentage point jump in our GDP just by everything resuming to normal.
One component of this return to normal is the vaccinated travel scheme that was launched in September with 2 countries, Germany and Brunei. According to Singapore Airlines, passenger traffic grew 4.4% that month, but passenger capacity is still at about 32% of pre-COVID-19 levels. Data from other markets shows the impact of border openings on the aviation sector. Here, the almost vertical line is the surge in bookings from Europe to the United States after Washington lifted its ban on arrivals from Europe. So there is potential for a significant uptick, especially when short-haul travel out of Singapore resumes.
When you have pent-up demand, we think that volumes will just spike up far higher than they were pre-pandemic.
This is somewhat analogous to the base effect that we see in economies where there's been a lot of depressed situation for a while and then there's suddenly a rebound and a spurt in growth. So that's exactly the kind of rebound that we are seeing in travel and tourism stocks in other parts of Southeast Asia.
In the longer term, market watchers say some sectors might be permanently transformed.
F&B and as well as the retail kind of commercial spaces, at some point they will realize that the office space is not what you really need or that shop front is not what you really need. So I think some of those sectors, the shift might be permanent in my view.
And there is also the unknown threat posed by potential new virus variants.
So even if there is a fresh wave, most governments will shy away from a lot of the restrictions that we've seen across the world in the past, because you also need the economy to thrive and people to make a living. That's equally important.
There is also the spectre of inflation as more economies reopen. This comes as Treasury yields jumped to their highest since June.
If we have stronger demand, then inflation is a concern in the near to medium term. Long term, it may not be a problem because more structural issues like an aging economy, an aging population, and structural disinflationary forces are still in play because of technology, etc. But short to medium term, I think the inflationary concerns are real. And it may be a little bit more persistent than we had initially thought. And I think that's what the market is worried about right now.
At its half-yearly review in mid-October, the Monetary Authority of Singapore unexpectedly tightened monetary policy. This is the MAS' first policy tightening since 2018.
We believe that moderate inflationary pressure will emerge in the first half of 2022, but we expect core CPI to remain within the MAS's 2% threshold. And this is going to get even easier as global supplies normalize, supply chain bottlenecks are removed, or alternate supply chain routes are, cemented.
Other international headwinds like rising energy prices and supply chain issues have yet to be tackled. While opening up may resolve them, there are risks as well.
as the economy opens up, supply chain will start to ease. But there is a time lag. And in the meantime, what we are seeing is a more intensified shortage or inventory concern, especially if demand rebounds very strongly. So I think we're in that kind of a scenario, a worst case scenario where risk of stagflation is increasing. Stagflation meaning economic growth is decelerating while inflation is rising.
So despite these headwinds, moving to endemic living has more benefits for the economy than not doing so. It may not create an immediate rebound, but it builds the foundation for businesses to grow again.
It rolls down to the other sectors. I think that'll benefit the economy in the right direction, especially an economy like Singapore, which is more interconnected and more of a global hub.
The point of being endemic, more than the fact that it allows physical movement, etc., is predictability. Without that level of predictability, it's very difficult to create business strategies over the medium to long term.